Assalamualaikum and hello everyone. I'm Madam Yusna Liza. This is the second part of the slide presentation on MFRS 3 business combination, and we are now at the stage of identifying a business combination. According to MFRS 3, an acquirer may acquire control over acquiree in a business combination when it transfers consideration in relation to acquire controlling interest as follows. This is provided in Appendix B5 of MFRS 3, where the first one is that through transferring of assets, either that's cash equivalents, or other assets, incurring liabilities, where as a result of business combination, you have to incur liabilities like debentures, for example, issuing equity shares as a result of acquiring control. You issue shares, right, to the acquiree, and the shares that you issue is the equity or the ordinary shares. Or D, where you provide more than one type of consideration, meaning that maybe two out of this A, B, C, or maybe the combination of all three. Yep. Okay. Next one. What's wrong with this? The next one is, sometimes it happens when you are not transferring or issuing consideration at all, but that was through a contract alone. Maybe there is some arrangement that enables you to get control and as a result have the business combination through a contract. Or maybe you buy back sufficient equity shares. The acquiree buy back sufficient equity shares, and therefore that enables you to have control. Or maybe minority shareholders or the non-controlling shareholders vetoes right prevented acquirer lapse. The third one is that maybe the acquirer, according to MFRS 3, or an acquiree enter into a contract. They enter into a contract that gave them or give the acquirer right to control, even though no consideration has been involved. That is the contract to combine their business. So for details, you can refer to the textbook, chapter 9, page 308. So under MFRS 3, business combination are accounted for by the acquirer, okay, applying the acquisition method, So it's the acquirer that will have to apply the acquisition method as follows. So the first step is to identify who is the acquirer. Second one is to determine the acquisition date, the date where the shares or the shares of the subsidiary were acquired by the acquirer. And step 3 is to recognize, where possible, at fair value, the identifiable assets acquired if the fair value can be measured reliably. The liabilities that are assumed in relation to the business combination, or any non-controlling interest should you acquire the subsidiary less than 100%. So non-controlling interest should be measured. So we will go into detail about non-controlling interest. And step 4 is to recognize and measure should there any goodwill or gain from a bargain purchase arise as a result of business combination. Let's look at the first step, step 1. Step 1, according to MFRS 3, the acquirer is more likely to be the entity that obtains control of another entity. An acquirer is usually, that is prescribed in paragraph B14, the entity that transfer the consideration, such as the entity that transfer cash. Let's say if the acquirer is the one that transfer cash, let's say the company is H is the one that transfer cash or incur liabilities to the acquiree, so therefore it is likely that H is the acquirer. The entity that exchanges or issue equity interest, which refers to the ordinary shares, to the shareholders of another entity, so that is likely to be an acquirer. But for your level, this is just an introductory question. The acquirer is normally clearly determined, which is the party that is holding the controlling interest or have more than half of the majority of the shares, which refers to ordinary shares or the voting shares. If the guideline under MFRS 3 is not really clear to indicate who is the acquirer, we will use the guidance in MFRS 10, which will be discussed in the different video. And it is likely that the entity that obtains control of the acquiree is the acquirer. So you can refer to the MFRS 10 lecture that will be uploaded. If it does not clearly indicate, let's say the information or whatever agreement or information available does not clearly mention or indicate which entities is the acquirer, MFRS 3 provides additional guidance, which is then considered. So you can refer this to Appendix B of MFRS 3, paragraph B13 to B14. You can refer that, or you can also refer that to your textbook. You can refer chapter 9. You can also look at your text, chapter 9, which is at page 314 to 315. So you can refer additional guidance, but for your level, acquirer will be clearly indicated. However, within this FAR 320 discussion of this particular course, reverse acquisition is scoped out because it is not in this course syllabus. If you are interested to know more about the reverse acquisition, you can go and refer to the MFRS itself. But we're not discussing reverse acquisition here. Okay, let's look at the illustration. It's a typo there. Illustration. Identifying the acquirer. So we have on the 1st of December 2000 X0, Faber-Hart has 100 million equity ordinary shares in issue. So 1st of January 2000 X1, Faber-Hart issued 20 million new ordinary shares. So Faber-Hart is the entity that is issuing shares to the shareholders of Faber-Hart in exchange for all 20 million Faber-Hart's shares. Okay, so let's see the solution here. Who is the acquirer? Who do you think is the acquirer? Of course, the indication here is where you have this entity that issue new shares to the shareholder of MAF, and the entity that issue new share is FAR, and therefore Faber-Hart is the entity that issues share, and because of that, Faber-Hart is the acquirer and Faber-Hart is the acquiree. As I mentioned, in your case or in the case of FAR 320, it will be clearly indicated. For details, that was in the standard. And now we move on to the second step under acquisition method, which is to determine the acquisition date. So if you like to have more details on these matters, you refer to MFRS 3, paragraph 8 and 9. I put some G's of it here. The acquisition date according to MFRS 3, paragraph 8 is the date when the acquirer effectively obtains control. The word here is the date that the control was being obtained. So that is the simple indicator that there is a control, and therefore that would be the acquisition date, the date on which the control is effectively obtained. So it's very easy to obtain the acquisition date. And if is also generally the date where the consideration is legally transferred to the acquiree by the acquirer. That can also be the indicator of the acquisition date. Or sometimes the acquisition date, if it's not mentioned clearly, the acquisition date will be the closing date, where on the date the acquirer acquires the asset and liabilities, assumed liabilities of the acquiree. Can also be other dates, at that dates can be earlier or later than the closing date, depending on when is the date the control is assumed, or when is actually the acquisition date. Acquirers, on top of just looking at the date that the control is obtained or on the date the consideration is transferred, it should also consider all pertinent facts and circumstances. But in our discussion here, the context of just an introductory course, the date of acquisition will be clearly shown, and it is normally on the date the shares were being acquired. The majority of the voting shares is being acquired. Now look at the third step, which is under the acquisition method, involving the recognition and measurement of the identifiable asset acquired and liabilities assumed, and the non-controlling interest, or NCI, non-controlling interest. I have mentioned about that earlier. So the recognition principle laid down by MFRS 3, paragraph 10 to 17. One of it is that as at the acquisition date, an acquirer must recognize. What must be recognized is that you need to recognize the asset, the liabilities and contingent liabilities that you assume, together with the NCI, should be recognized separately from goodwill. What is most important is that it must meet the definition of assets, liabilities, and that is given as per the conceptual framework for the preparation and presentation of financial statement as issued by the ISC. In terms of measurement principle, that was explained in paragraph 18 to 20, where assets and liabilities that is related to the business combination that qualify for recognition should be measured on the date of acquisition at the fair value, and it must be part of what the acquirer and acquiree exchange. So meaning within the context of business combination, it shouldn't be other than that. It must be those related to the acquisition of business. Or maybe it will also involve additional asset and liabilities not previously recognized and may arise, needs to be recognized. Sometimes on the date of acquisition, you may have done some revaluation of assets. So revaluation of PPE, for example, right? So previously there were no revaluation surplus, and due to the revaluation that took place on the date of acquisition, you may have recognized some revaluation surplus, and that give rise to asset revaluation reserve on the date of acquisition, and these must be recognized. The revaluation surplus must be recognized. Okay, next, step 3 is still within the same discussion. If you can still recall, we are still talking about step 3 here. I'm going back to show you where is it. Okay, yep, here, recognize and measure the identifiable assets, liabilities, and NCI. That was step 3, and that gave rise to business combination. And what we're going to do now is we are looking at the business combination, where acquirer needs to recognize only the consideration transferred and liabilities assumed in relation to gain control of the acquiree. That will be measured at the sum of, so focusing on the liabilities that are being incurred or assumed, right? It should be the sum of asset transferred by the acquirer. Consideration transferred is relating to asset. Liabilities incurred is relating to liabilities. Consideration transferred is asset that is being transferred. So the asset transferred by the acquirer, the liabilities incurred by the acquirer to the former owners, which is the acquiree. If you buy from the shareholder, so you need to go and transfer the assets and liabilities incurred in relation to the business combination, the equity interest issued by the acquirer. At the same time, this may also involve some acquisition-related costs. Acquisition-related costs are excluded from the cost of business combination, or should be excluded from the calculation of the consideration that you will be transferring net of liabilities to the acquiree. So it should be excluded and will be expense of in the year incurred. Expense of in SOPL, but that one will be done in the year incurred. Should be expense of. And the contingent consideration included should be at the fair value. We're not going to discuss this in detail, but just for your information, the contingent consideration will also be included at the fair value on the date of acquisition. And recall that fair value is the price that would be received to sell an asset, or the amount to be paid to transfer a liability in an orderly transaction between market participants at measurement date. So this is not under this MFRS. You may refer MFRS 13, fair value measurement. If you still recall earlier, you transfer the asset during business combination in step 3, and you recognize and measure, and then incurring liabilities, and sometimes it will also involve consideration paid to acquire the equity shares of the subsidiary, and this is called consideration transferred, that is measured at the acquisition date fair value. So for the acquirer or the investor, the shares acquired will be the financial assets, which is the investment. This will be accounted for in accordance with MFRS 9, right? However, the shares acquired are recorded as investment and will be disclosed as non-current asset in the separate statement of financial position of the investor, if the investor intends to acquire control. So it will be disclosed in the statement of financial position of the company that acquire the control. The company that acquire the control. right? Or if you talk about influence, if you are the one that exert influence, significant influence, so those company shares that were acquired, but that is not within our discussion because this will involve investment in associate. We are looking at the investment in a subsidiary. So the consideration transferred, which is part of the third step, recognition and measurement, right? Recognition and measurement of the asset, liabilities, and equity shares, right? So that will be under your consideration transferred. It will be measured at the fair value, the asset transferred by acquirer, liabilities incurred by the acquirer if there is any deferred consideration, equity instrument issued by the acquirer, and if there is any contingent consideration. And this consideration transferred, the component of consideration transferred to the acquiree will be the initial acquisition cost of the investment, which will be recognized in the separate financial statement. We'll not go into detail this because this is an introductory level, but it will be given in the question clearly if you talk about question doing, but this is for knowledge sake. So you can refer example 1 later. We will be doing that in the slide presentation to apply the acquisition method. We'll go into that after our step 4. So asset transferred by the acquirer, as I mentioned, should be measured at the fair value. And if the investment is at fair value, the non-financial asset is under the non-financial asset given, such as property transferred to the acquiree, shall be measured in reference to their market value. However, if it's a financial asset, the definition should match the MFRS 132, which is on financial instruments presentation. Consideration transfer, they are measured at the present value, the liabilities there, and the consideration will, and that is not at the nominal value payable. It must be measured at the present value. If you are to pay them in the future, you need to discount that back to the present. The rate of discounting is the acquirer's current borrowing cost if you were to discount that to the present. If the liability issues is deferred, meaning that not yet settled within 1 year, the amount is discounted to the fair value. If there is any future loss to be incurred, that are not liabilities, that is expense. Equity instrument issues. Okay, this one there's some correction here. It should be MFRS 9, yeah, MFRS 9, because MFRS 139 is being replaced with MFRS 9. So let me just do a little bit of correction here. So MFRS 9 and MFRS 9 is on financial instrument. So on financial instruments. So MFRS 139 is no longer in place whenever you have referred to MFRS 9. So that clarifies the other valuation methods and technique. And this one you can read on your own because I'm not going to go into detail. Contingent consideration involves transferring assets to the former owners. So this is the third part of the third step, the fourth element under the recognition and measurement. Remember, number 3 is on recognition and measurement of the assets and liabilities, right, that were incurred relating to the business combination. So therefore, contingent consideration will involve the transferring of asset to the former owners, and the owner here, is the acquiree, the one in the acquiree, if this is the case of contingent consideration on the occurrence of an event in the future. So this as well will not be so much of our focus for FAR 320. However, what you need to understand is that you need to recognize liability at the acquisition date fair value, even though there is no possibility that the event is occurring. So the fair value of the contingent consideration, if there is any, will still be part of the consideration transferred. So obligation of the acquirer to transfer additional asset, it may be after 2 years of acquiring control, you need to transfer some additional asset or some issue more shares to the owners in the acquiree. So therefore, that is to be specified as well in the consideration transferred. Contingent transfer will give right to the acquirer also to return the previously transferred consideration if conditions are met. Acquisition related costs, as I mentioned, that were directly related to effect a business combination. Those costs are directly attributable costs. What are those examples? They are like finder's fees, advisory fees, legal fees, accounting fees, valuation fees that you pay to the evaluator or assessor, other professional fees, fees paid to the accountants, fees paid to the engineer, fees paid to the architects, consulting fees. These are all going to be expense off, right? General admin costs, these are all costs in nature. So cost of maintaining the acquisition department, for example, cost of registering and issuing debts and equity instrument. So this shouldn't be included in the consideration transferred calculation or the cost of the business combination. Another name for consideration transferred is the cost of business combination, but that is better known as consideration transferred. So that costs relate to the consideration, which are acquisition related costs, should be recognized as an expense in the period in which the costs are incurred. Or if it's a management fees, income, those, for example, are services, right? It should be recognized as they are when the services are received, or in simple word, the performance obligation are being satisfied by the seller. The cost to issue debt or equity instruments shall be recognized in accordance with MFRS 132 and MFRS 9. So I'm making another simple adjustment there because that is something that need to be corrected. So I just do the correction. So I am deleting it. So it should be just MFRS 9. Okay. Next, we move on to the following information that is explaining further on acquisition related costs. So these are the example, and in accordance with MFRS 9, again, such costs shall be included and reduce the proceed in the initial measurement of the liability. If that is relating to, let's say, issuance of debenture, and you have the issuance cost of debenture. That should be reducing the cost of debenture, meaning that debited to the debenture account. Meanwhile, the cost of arranging, registering and issuing equity instruments that relates to the issuance of equity issue transaction. Yeah, so that equity issue transaction or issuance of shares, if you have any expenses on share issuance, that cost shall also reduce the proceeds from the equity shares issued. So this is example 1 that will be applying what I have explained in the acquisition method, that is the method to account for business combination. Let's look together and let's read this. 1st of October 2000X8, mom acquired 60%. Okay, 60% is some fairly easy determination of control in daughter. So 60% from the 10 million share capital in daughter. So 6 million are acquired by mom. So because of that, daughter will now pronounce as the acquiree or the subsidiary. The issue on shares capital in mom was 50 million. So this is the one in mom itself. And the consideration transferred was as follows. Remember, the consideration transferred can be a combination of asset, shares, and also liabilities incurred. We'll be looking into that. The first one is an immediate cash payment of 10 million. That means that we transfer cash to acquire the investment in subsidiary. Second one is a share exchange of shares. 2 shares in mom for every 3 shares in daughter, when the market price of mom's shares and daughter shares was 3 ringgit and 2 ringgit respectively. Ringgit Malaysia RM3 is for mom and RM2 is for daughter. That was the market or the fair value of the shares on the date of acquisition, which is 1st of October 2000X8. Issuing 5% debenture, this is part of the consideration as well. To daughter, you paid or you issue debenture worth 600 million. And the cost to issue the 5% debenture, which is the issuance cost that will have to reduce the debenture, amounted to 10 million. Professional fees paid to accountants, which is going to be expense of, is 100,000. So number 1, you have to compute the consideration transferred, which is to compute the cost of business combination itself. Cost of business combination itself. All right, something wrong just now. No worries, it's under control. Right, and you're going to compute that on 1st of October, and 1st of October is the date of acquisition. And you're going to show the relevant journal entries to account for investment in mom. Yeah, investment in daughter, which is the acquiree. So the acquiree is daughter, the acquirer is mom. We're going to show that in the financial statement, and that will be done in the next video. With that, I thank you for watching. Remember, this is the second part of the slide presentation for MFRS 3 business combination. You are going to continue with the remaining, which is part 3 of it, in the following video. I thank you for watching. I'll see you and I will see you.